This LOS is describe issues in valuing and calculating returns on hedge funds, private equity, real estate, commodities, and infrastructure. So first we're going to look at hedge fund valuation issues. When market prices or quotes are used for valuation, funds may differ in which price or quote they use. For example, bid price, ask price, average quote, and median quote. A common practice is to use the average quote, which is the bid plus ask divided by 2. However, a more conservative approach is that to use the bid prices for long positions and the ask prices for short positions. We saw in the previous LOS that in the text there's a nice section here with regards to hedge fund valuation issues and a couple of practice questions. Okay, so the values of non-traded securities can be estimated with pricing models, and with regard to illiquid securities, we can reduce the market price to account for illiquidity based on size of the position held. We can call that a liquidity haircut, okay? And the trading net asset value is adjusted downward for liquidity. So recall we looked at this practice question in a previous LOS, but we'll just take a quick look at it again just as a reminder. So a hedge fund with a market neutral strategy restricts its investment universe to domestically publicly traded equity securities that are actively traded. In calculating net asset value, the fund is most likely to use which of the following to value underlying positions: A, average quotes, B, average quotes adjusted for liquidity, or C, bid price for shorts and ask price for longs. So recall the correct answer here was A, the fund is most likely to use average quotes. That could be because the securities are actively traded, so there's no liquidity adjustment is required. If the fund uses bid ask prices, the fund would use the ask prices for shorts and the bid prices for longs. These are prices at which the positions could be closed. And remember, there's another practice problem where the hedge fund is investing in distressed debt. Quoted market prices are available for the underlying holdings, but they are traded infrequently. So in that case, we wouldn't use, for calculating the net asset value, we wouldn't use the average quotes. We would use the average quotes adjusted for liquidity. And so that was the issue with regards to valuation with hedge funds. Moving on now to private equity structure and fees. Private equity, we've seen, are typically structured as limited partnerships, similar to hedge funds. Investors provide committed capital, which fund managers draw down to invest in portfolio companies. So the management fees on private equity are typically 1 to 3% of the committed capital. There are sometimes incentive fees, typically 20% of profits, and fees paid periodically may exceed 20% of profits over time. There can be a clawback provision requiring managers to return excess fees. Now we'll look at private equity valuation. Same techniques used to value publicly traded companies are used to value private equity portfolio companies. So we can use a market comparables approach, a discounted cash flow approach, or an asset-based approach. Private companies may require different discount rates or price multiples than publicly traded companies. Moving on to real estate valuation, there's 3 approaches here: the comparable sales approach, the income approach, and the cost approach. The comparable sales approach is easy. You just look at recent sales of similar properties, okay? And you usually can get a per square foot price. And you can compare to that. How are you doing per square foot? $1,000 per square foot, $500 per square foot. That's the comparable. The second approach is the income approach, which the first one is the present value of the future cash flows from the property. And the second is the net operating income divided by a capitalization rate, okay? And finally, number 3 is the cost approach, which is the replacement cost, including land and current costs to rebuild. Now we're going to look at real estate investment trust valuation, the REITs, real estate investment trusts. Income-based is similar to direct capitalization. We can look at the funds from operations, the adjusted funds from operations, and capitalization rates. If we're looking at asset-based, the net asset value is the market value of the assets minus the market value of the liabilities divided by the number of REIT shares outstanding. And that would be the same type of valuation approach pretty much for any mutual fund, where you look at the market value of the assets minus the value of the liabilities divided by the number of the shares outstanding. That's net asset value. And finally, with regards to the pricing of commodity futures contracts, the futures price equals the spot price times 1 plus the risk-free rate plus the storage costs minus the convenience yield. The convenience yield is the value of having the physical commodity available for use. So if there's a very low convenience yield, you can see we're subtracting that, then the futures curve is in contango. The futures prices will be higher than the spot price. But if there's a very high convenience yield, the futures curve will be in backwardation, meaning the spot price will be greater than the futures price. And we'll just finish this LOS with one quick practice question that we did see before. It's just nice to review it. If a commodities forward curve is in contango, the component of a commodities futures return most likely to reflect this is A, the spot prices, B, the roll yield, or C, the collateral yield. Okay, hopefully you recall that from the previous LOS, that B is correct. Roll yield refers to the difference between the spot prices of a commodity and the price specified by its future contract, or the difference between two future contracts with different expiration dates. When future prices are higher than the spot price, commodity forward curve is upward sloping. Prices are referred to as being in contango. Contango occurs when there is little or no convenience yield. And that's the last slide for this LOS. Thank you.